Hi, this is Jessica Dunn, and this is Economic Development Finance. And today we're going to be discussing the role of debt and equity. There are two forms of investment. There is debt and there is equity. Equity represents ownership in a company and is represented through shares of stock. So those that own the stock or the shares are called stockholders or shareholders. Those terms can be used interchangeably, and every share of stock or every stock represents a fractional ownership of the company. So the more stock you own, the greater the percentage ownership of a company that you have. Equity is received in exchange for a financial or other contribution to the business. Equity investors receive dividends. Dividends are those payments that the company has earned but doesn't reinvest in the business. And they earn money through gains and losses in the share price. So when they buy and sell their ownership stake, they can make money from price appreciation, or while they hold the company, they can receive income in the form of dividends. Equity returns are not fixed. The business is not obligated to make payments to the owners, and earnings are not limited if the business does well. So there is unlimited upside, and there is a limited downside because you can only lose as much as you put into the company. There are two forms of stock, preferred stock and common stock. Common shareholders are, as it says, the most common shareholders. These common shareholders have both a financial and a governance right. So that means that they have claims on dividends and they have the right to vote in elections. So when I say that they have the right to vote in elections, I mean that they have the ability to elect board members, vote to approve mergers or acquisitions. They have the right to vote for new stock authorizations or any major business decision. Preferred stockholders, um, these stockholders kind of have a hybrid position. So it's kind of a mix of debt and equity. They are equity holders. So let me reemphasize that the preferred shareholders are equity holders just like common stockholders, but they do have some advantages. Those advantages are that the dividends that the preferred stockholders receive are promised. So they actually have a promised return. Now that those dividend payments that they are promised, they're usually set at a fixed rate and they're usually cumulative. So what that means is that if the company had a bad year and they weren't able to make the dividend payments as promised to the preferred shareholders, then they could delay that. But it would be cumulative. So if they missed this year's dividend, they would have to pay that dividend next year plus next year's dividend. So it would keep adding to. And the common shareholders wouldn't be allowed to receive a dividend at all until those preferred stock dividends in arrears have been paid. Now, not all preferred stock is cumulative, but most is. Um, and so again, if their promised dividend is skipped, because again, it's not only promised, it's not contractual. If that promised dividend is skipped, then that skipped dividend payment has to be paid. So all dividends in arrears have to be paid before common shareholders can receive a dividend. You usually acquire preferred stock through venture capital. So it's not what you see most commonly, as we refer to common stock. You usually do only receive that in the event of a pre-IPO investment. An IPO is an initial public offering. The most important issue in equity financing is company valuation. That determines how much investors have to pay to purchase a portion of the company. This is very much an art and not a science. We're basing our value on expected future cash flows and rates of return. So it's not an exact science, and there are different rules of thumb that we'll get to later, but and it's very much an art. Investment terms exist to protect financial and governance rights. The preferred stockholders are often allowed to elect one member of the board. They sometimes have greater than equal voting rights. So They may only own 1% of the company, but they get 5% of the votes. So they're getting a greater amount of votes per share. And there are often anti-dilution rights. These rights will protect shareholders in the event of stock splits. There are some advantages of having equity. The first is that there is no fixed payment required. So with a debt obligation, when you borrow money from a financial institution, there is going to be an amortization schedule, and you're going to be required to pay back a portion of that borrowing every period. So there's a fixed obligation there. With equity, there is no fixed payment requirement. And that's even true if you have preferred stock, because remember, preferred stock is promise a dividend and it is often cumulative, but those dividends can be deferred. So there's no contractual fixed payment requirement. Equity is also a long-term source of funding. So when you're concerned about building a company value, this gives you access to capital that is patient. It doesn't require immediate payments. It's there forever, so it's very long term. And so you can use that money to finance major fixed assets, startup costs, things that are going to take a long time to recoup. A third advantage is that it leaves the firm's assets available for other financing needs. So equity investors do not claim a firm's assets as collateral. So whenever you borrow money from a bank, that bank is going to require collateral against the loan. So, for example, if you borrow money to buy a house, that house that you're purchasing is the collateral for that loan. If you don't repay that loan, then the bank is going to take your house. So whenever you use equity, you're not having to pledge any of those assets as collateral. The assets that a firm purchases with equity can then later be used to raise debt because there is no claim against those assets. There are fewer restrictions on the use of funds and the financial status of a company than when you're using debt. Debt providers often impose financial covenants that say how loan proceeds must be used. These equity holders do, however, get voting rights, so they do get a say in what happens, but there aren't any restrictive covenants. There are, however, disadvantages of equity. First, it dilutes ownership and control. So those existing owners must give up some ownership, and they do have to open up to the direction of board members. So the board members are now going to be elected. They're going to get some control on business decisions, and they will have to allow others to select management and such as the company grows. Another disadvantage is that it's not very available, so there's limited availability. There are lots of sources of debt financing, and that's because debt is protected. There's contractual provisions that require debt to be repaid, and if it isn't, then they're able to seize assets. So there are lots of people willing to provide debt because it is much less risky. And they're promised a return. Equity investors aren't. Equity investors are few and far between. Few firms fit the investment criteria of venture capitalists or are ready for an IPO. So finding an investor prior to that is often very, very difficult, and you're relying upon friends and family. Equity is also very expensive. Investors expect high returns for the large risk associated with investing because, again, they have no protection. So usually investors require a large share of stock for a very modest infusion of capital to protect them for the risk. So on the flip side is debt. Debt is a contract between a lender and a borrower. The funds are provided to the borrower and repaid to the lender. So these borrowers must repay funds according to a defined interest rate and a stated repayment schedule. It's different from equity because these debt holders have specific terms for how the investor is to be repaid. Debt holders' return is set by contractual terms. Unlike equity, whose return depends upon future earnings and the value of the company, debt is a fixed obligation that must be repaid regardless of earnings levels. If a firm fails to make a debt payment, lenders have the right to sell a specific firm asset to obtain that promised repayment. Debt does not get any governance rights to the debt holders, so they're not able to elect board members or make specific decisions. They cannot exercise control over the firm's governance and management. The one ability that they have, however, is to place restrictions and covenants within that debt agreement. So examples may be that the company is not allowed to pay dividends above a certain amount while that debt is still in place. It may require that companies are not able to sell certain assets, or that managers' salaries cannot be increased above a certain threshold while that debt has not been repaid. And it may require that companies maintain life insurance on key employees. So lots of different things that debt holders can do to protect their position. Debt contracts are going to address financing terms. So that's the size and the timing of the payments, the lender's rights to collateral. It's going to specify the principal, which is the amount of funds that were borrowed. It's going to specify the interest rate, which is the price charged for using borrowed money. It's calculated using an annual percentage rate. It's going to tell you the loan term and maturity, which is the amount of time to repay the loan, and the amortization period, so the amount of time the loan is being amortized. So here is a amortization graph to help convey this information. Here we see the top line, the dashed line. That's an interest-only loan. So an interest-only loan, as it states, you make interest-only payments. So the principal balance never decreases. All you do is pay the interest accrued every month, and at the end of your 20-year term, you still owe that principal amount. You haven't repaid any of it. The dash line is a partially amortized loan. So what that means is that you are repaying the interest accrued each month plus a portion of the principal. This is also referred to as a balloon payment. So what that means is that at the end of the life of the loan, so let's say 20 years from now, you have repaid interest accrued to the loan and you have repaid some of that principal, but not all of it. So at the end of that loan term, you have a significant amount of money that's owed to the bank or to the lender, and it's need to be repaid in a full amount. So in this example here, we have $1 million loan. We owe $1 million. That's the principal. That's the amount that we initially borrowed. So the principal of the loan. With that partially amortized loan, we have paid principal, not the complete amount, and all of the interest due. So at the end of 35 months here, we see that we still owe roughly $500,000, and that's due at the end of the 35 months. So you need to have a check available to write. Now the benefit to the lender of a partially amortized loan is that the benefit to the borrower is that they have a reduced payment. So your payment is not going to be nearly as high as it would be if you had a fully amortized loan. Now it also helps protect the bank in some circumstances. So the bank is able to say, okay, this is a pretty risky loan. Let's require a balloon payment. So we're going to amortize this loan as though it's a 40-year loan, but at the end of 20 years is when it's actually due. So you owe us $500,000 at the end. And that gives the bank the option then to refinance that loan at the 20-year mark for the remaining $500,000 and let you finish amortizing it. Or it can say, you know what, you've been a terrible borrower, your payments are consistently late, you're not living up to the contractual terms that we've set, you have to find a loan elsewhere to finish this loan, or you have to come up with the $500,000 now, or we're going to seize your assets. So it gives the bank an out. A fully amortized loan is the solid line. So with a fully amortized loan, we see that at the end of the life loan, upon maturity, you have a $0 balance. So you know nothing on that loan anymore. So you have paid the interest obligation as promised. You have repaid the principal component over time in such a way that at the end of the maturity, your loan balance is $0. Now, with each of these, their payments are going to be drastically different. So an interest-only loan is going to require the smallest monthly payment. So it's going to be very minimal. But again, you're not reducing that principal balance at all. A partially amortized loan is going to have a slightly higher monthly balance, but upon maturity, you're going to owe substantially less than the principal amount. A fully amortized loan is going to have the highest monthly payment because at the end of maturity, you're going to have paid off that loan. So the primary benefit for taking out a partially amortized loan or an interest-only loan is that the payments are reduced. The amortization period influences the monthly loan payment and the principal balance over time. So here is an example that is a loan that I actually had. I no longer have it, but I like to show it to you guys because I think it's very interesting. Now, I'll give you some context. This was in 2015, so I had been at Murray State for about a year. I had 3 children at the time, and my husband was not working because he was watching the kids because I just started a new job, and our dream piece of real estate became available. And so we decided that we needed to make it happen. We already had a house elsewhere, and that house we did have it paid for, so there was no debt burden there. But the previous year, we had invested some money into a commercial building, and it was a sizable mortgage, and the bank felt that this loan, due to my lack of employment history, was a little bit risky. And so they gave me a partially amortized loan. So you can see this loan here was the loan balance was $135,000. So we had paid $150,000 for the land, and we put 10% down, which was the minimum. So we financed $135,000. We purchased it September 14th of 2015, and this loan matured on September 14th of 2020. We see that this is a mortgage, and you can find mortgages. They're filed in the courthouse. This is public information. We see the principal amount's $135,000, and the interest on this was 5.25%. So now this interest rate is fairly high. Again, I told you this was a risky loan for the bank because I had not very long employment history. I just purchased a commercial building, and my husband wasn't working. And so they felt that it was pretty risky for them to partake on, so they gave us a high interest rate, and they only partially amortized it. Now, this has been refinanced since then, but I wanted to show you why I chose to partially amortize it or why the bank chose to partially amortize it. First, it was to protect the bank because in 5 years, if I wasn't a good borrower, they could seize the land and resell it. And because my debt to income was fairly high, so they gave me a partially amortized loan, which reduced my monthly payments. So if this loan had been fully amortized, so meaning they had given me a 5-year loan and it was paid off in 5 years, because this is a 5-year loan, but it's paid off in 15 years, so it has a monthly payment. If this loan had been a 5-year loan and had to be paid off in 5 years, a monthly payment would have been $2,563 a month. So very, very high. But the way this loan was structured, I have a 5-year loan that was amortized over 15 years. That means that my payment was only $1,000, $1,085. So the monthly obligation to me was substantially smaller. So that was the benefit. It reduced their risk because at the end of 5 years they had an option to not refinance. And it made my monthly debt obligation substantially smaller so that I could afford it. Now, I don't know how many of you have seen a mortgage before, but they're very, very long and very lengthy, and they tell you what you can do and what you can't do, and all the penalties that they can charge you. It's going to give you a copy of the deed. The deed is recorded in here as well. And there's going to be lots and lots of fine print. You can find these at the courthouse. Go down to the deed room. They have all mortgages on file. You can look any of them up that you wish. So it is public information. And here's the amortization schedule for that same loan. Here we see that our first payment was $1,085. $582 of that went towards principal, and $502 of that went towards interest. I'm sorry, I had it backwards. $582 towards interest and $502 towards principal. So our payment stays the same throughout the life of the loan. That's how amortization works. It gives you a constant payment. But we see here that the amount of our payment that goes towards interest decreases every month. So our first payment, $582, went towards interest, and my 40th payment, $508, went towards interest, which means too that the amount of principal that you're paying every month is increasing. So this is why it's often beneficial, to pay a slightly higher amount than your loan balance, or your minimum required payment. So if you have a mortgage and you apply an extra, $10, $20, $100 a month, whatever you can afford, it's going to drastically reduce the amount of interest that you're going to pay, because that additional amount is going to go directly towards principal. Because you can see in the early life of this loan, over 50% of the payments going towards interest. So any additional, $10, $20, $50, $100 that you can apply to this loan is going to directly go towards principal and reduces your future interest obligation. So we see here when we scroll down at the end, I owe $101,797.73. So at the end of 5 years, I initially bought this land for $135,000. I paid $1,085 a month, and I still owe $101,000 at the end of that 5th year. So this just shows you how a balloon payment works. A partially amortized loan, you do have this substantial amount at the end, and the bank can then choose whether or not to stretch that out to continue to loan to you, which obviously you probably wouldn't make that decision at the end of 2019. You probably would have said, okay, well, somewhere up here, let's look at the end of 2017 or mid 2018, and let's see if that bank is willing to extend that loan, amortize it for a longer amount, or I guess stretch out the maturity, keep the amortization the same if you want to pay it off in 15 years. You would make those decisions beforehand instead of waiting until the end and saying, oh no, bank, what are you going to do? Because you would need to have made some planning. So again, with a loan, a lender is going to require collateral. They're going to require you to pledge specific assets against that loan. If the borrower does not repay the loan, then the lender will seize the assets. The ability to receive assets as a debt holder depends upon seniority. So a senior loan would have first claim at assets. A subordinate loan would have a second claim on assets, or third or fourth, how many ever there are in order. But the more senior the loan, the higher the claim you have against the assets. If loans are secured with real estate, they are considered mortgages. If they are secured with equipment, they are considered equipment loans. If they are secured with unpaid invoices to customers, then they're accounts receivable loans. Oftentimes with a business loan, the debt holder is going to require a guarantee from the owner. This is when a guarantee is required when the financial performance is weak or the collateral is insufficient. Personal guarantee is from your private wealth, and they may need a guarantee from a parent company. This can also be provided by a government program like an SBA loan guarantee. Mortgage insurance is another form of guarantee. But typically, if you own a substantial portion of a company, when that bank lends you money, they're going to require some sort of personal guarantee against that loan. So here are some formulas that are used by lenders. First, we see the debt service coverage ratio. The debt service coverage ratio is calculated as the annual cash flow available to pay the debt service divided by the principal and interest payments. This measures how a firm's cash flow compares to the required principal and interest payments, so the debt service requirements. Minimum coverage ratios are generally between 1.2 and 1.25. Lenders like a higher ratio because that means there's a larger cash cushion for the loan payment, so it gives you a lot of variability. It gives you some protection. If your income is down, they can still have room to make that debt obligation. So that means that the business has 20 to 25% more income than the debt cost. The loan to value ratio is calculated as the total loan principal amount divided by the value of the pledged loan collateral. Typically, lenders want a loan to value ratio of 0.8 or lower. So that means that if you have an asset that's worth $100,000, the bank is only going to lend you $80,000 against that asset. The reason for that is because banks, in the event that you could not pay, the bank would seize that asset and then they would sell it. And typically the bank is not very good at selling assets. They usually take a loss on them. They can't sell them for the full amount because whenever you look at a foreclosed home, you obviously first think, well, we don't know everything about its history. There might be something wrong with it. Let's pay less for this home than we would a comparable. So they're only willing to lend 80% of value. And again, that's a protection mechanism for the bank. So they can take a 20% loss on value and still recoup their investment. So here's an example. This company is going to borrow $200,000. The monthly payment on that $200,000 is $2,750. There is $3,500 available in cash flow per month to service the debt, and the collateral has a market value of $250,000. So let's calculate the debt service coverage ratio and the loan to value ratio to see if this is a good loan, if it can be approved. So first up, let's do debt service coverage ratio. So the annual cash flow available to pay our debts would be equal to the $3,500 that we have available per month times 12, because we're looking at annual here, and we divide it by our annual principal plus interest payments. Now this loan has a monthly payment of $2,750. So if we were to multiply that out, we would have 1.75. And remember that the minimum debt service coverage ratio for a bank is usually between 1.2 and 1.25. So better than 1.2 or 1.25 is good. So this is good. Put a check mark beside it. And now let's look at the loan to value ratio, because both of these have to be good to make the loan. It can't be just one or the other. We have to have enough cash to service the loan, and we have to have an asset that's worth enough money in the event that this loan goes bad, that the bank can still recoup its cash. So our loan to value ratio. The total loan principal, we're borrowing $200,000, and the value of the asset is $250,000. So that gives us a loan to value ratio of 0.8. And we said that the loan to value should be 0.8 or lower. So that means that they're loaning 80% of the value. So this is also good. So this is a good loan. So the numbers make sense. It's greater than 1.2, 1.25, whatever the bank's rule is, and it's greater than or equal to, and it's less than or equal to 0.8. So both of these qualifications are met, and this is a loan that should be approved. So let's look at the advantages of debt. First up, there is no dilution of ownership. The owners can retain control of the company. They can make all the decisions. They're not losing that claim on income. Debt is a much cheaper source of financing than equity because these lenders are bearing less risk because they have contractual provisions that require them to be repaid, and the punishment if those contractual provisions aren't met. So the asset could be seized and resold. So they have less risk. They're receiving regular payments, and they receive collateral in the event of financial distress. So that makes it a cheaper source of financing than equity. In addition to that, the interest portion of debt is tax deductible. So companies are able to deduct that interest payment against their taxes. And there's a lot more debt available than there is equity. The company can receive credit from its suppliers, so trade credit. That's the largest source of financing in the country. So your bread man delivers bread on Monday. You don't have to pay up till the following Monday if you're a restaurant. That would be trade credit. Corporate credit cards, the owner's personal credit. They can take out a HELOC against their home, a home equity line of credit, to use to finance their business. They could take out a second mortgage. They can get a loan from a bank, a loan from friends and family. So there's a lot more debt available than there is equity. Disadvantages. The debt must be repaid even if cash flow is poor, because there is a fixed repayment schedule. The second disadvantage is collateral. Firms are required to pledge assets as collateral. This limits the business's ability to borrow in the future because that asset has already been pledged. Remember, with equity, no assets are pledged, so they can later take those assets that were purchased with equity and borrow money against them. Lenders, third is financial restrictions. Lenders may establish financial restrictions that can reduce operating flexibility. So they can require companies to hold a minimum cash balance or maintain certain financial ratios, or they could restrict the use of assets that were used as collateral. And fourth, a personal guarantee. Lenders may require a personal guarantee from the firm's owner to ensure debt repayment. Typically with federal programs, if an individual owns 19% or more of a company, then they're going to require a personal guarantee for that loan. So we've already discussed the difference between debt and equity, but within that we can break debt and equity down into smaller components. So let's get started, and we'll first talk about debt. So the first form of debt is a short-term secured loan. A short-term secured loan includes accounts receivable financing, inventory loans, and lease sales financing. Short-term secured loans usually have a maturity of 1 year or less, and they're typically used for working capital. They're usually financed through commercial banks. Companies need working capital, and they often need temporary increases in working capital because of seasonality, but sometimes they need permanent increases in working capital because they have started extending credit to their customers. Working capital focuses on the most liquid of assets, those current assets and current liabilities. So working capital is focused on offering credit to customers and purchasing inventory because of seasonality issues. So those are the two main causes for needing increases in working capital, either temporary in the form of inventory or permanent in the form of credit offered to customers. Because working capital increases usually generate money immediately, they can often be financed with short-term loans. So short-term secured loans include the accounts receivable financing, which is a short-term loan secured by money owed to the firm by customers. An inventory loan, which is a loan used to build up seasonal or permanent inventory, or time sales or lease sales financing. This is where a business would sell an asset to the lender, and then the lender would lease that asset back to the customer. They would do this because that would allow the lessee to obtain 100% financing, so it would be more convenient, and it would allow the lessor to retain any residual value. So when the company was done with that asset, they would still own it, and they could then sell it for its residual value. It's a very creative financing alternative. So the second type of debt would be medium and long-term secured loans. These include term loans, construction loans, and real estate mortgage loans. Economic development offices most often offer medium to long-term secured loans. Medium-term loans, these are loans with a maturity of 3 to 7 years. These loans typically fund fixed asset purchases as well as increases in inventory and increases in receivables. So a term loan, this is medium term, it's secured by assets. A construction loan finances the erection of a building. It's secured by the proposed structure as well as the land that it is sitting on. The disbursements for a construction loan are usually made in phases, so you can't receive 100% up front. To protect the bank, to ensure that you are actually doing what you promised you would do with the money. Long-term loans, these finance property, plant, and equipment. Real estate mortgage loans are loans that are secured by the deed. So in the event that you don't make the promised payment, then you would lose your real estate. The bank would seize it and then sell it. Unsecured loans, these loans have no collateral. This keeps assets available for other borrowing needs, and they're generally short-term. Trade credit is an arrangement between a goods and services supplier and customer. This is the largest single source of short-term financing for businesses and the most informal. There are 3 types of trade credit. An open account is where the customer is given a set number of days to pay off the invoice. So they would say, okay, bill is due in 7 days. Let's open an account. Notes payable is written evidence of a purchaser's liability to the seller. And trade acceptances, this is where a seller draws a draft or a request from payment directly on the purchaser's bank, ordering payment of draft at a future date. So they're under a contractual obligation to pay. This is most often used in international transactions. Another type of unsecured loan is a line of credit. A bank would provide access to money with a stated maximum for a set term. The borrower would then pay interest on the amount borrowed. Line of credits typically for a business are going to have to be cleaned up once a year. So that means they have to have a $0 balance at least once per year. Lines of credit are not always unsecured. You can get a lower interest rate if you do secure that line of credit, so you have an asset pledged against it. That would allow you to get a lower interest rate. So in personal finance world, a home equity line of credit, it's a line of credit against your house, a HELOC. You can also have unsecured lines of credits as an individual, but again, they're going to have a higher interest rate. Commercial paper, this is short-term unsecured promissory notes. They're sold by the firm to investors. They're usually sold at a discount, so what that means is the face value of the loan's $100,000, but they sell for $90,000. So upon maturity, when that loan's repaid, the individual would receive $100,000. So that's how they would receive a return from their investment. Bonds are long-term debt instruments that are sold publicly to raise money. Private firms and governments use this tool. Bonds can be secured, so they have collateral, or unsecured. And they are sold in one of three ways. A competitive sale, which is where an issuer sells bonds to an underwriter through the competitive bidding process. A negotiated sale, this is where an underwriter is selected prior to the bond sale. They are given exclusive rights to purchase bonds at an agreed upon price. An investment bank then helps the issuer structure bonds and markets them. And a private placement is where bonds are sold directly from the business to the investor. Bonds are debt instruments. They do have fixed interest payments, and they have a face value that is paid upon maturity. So when we talk about bonds, I like to think of them as interest-only payments because that company is making interest-only payments throughout the life of the bond, and upon maturity, they have to repay the principal amount borrowed. Equity financing. This is money that is taken in exchange for ownership of the company. There are different types of equity financing. We see that early stage investments are usually made prior to the company being profitable. So this line is profitability, and we see that pre-profit, that's considered seed capital, and sometimes venture capital. So very early stage investments. Seed capital is similar to venture capital, but occurs at the pre-production phase before companies see. It's often pre-revenue and usually always no profit available. Venture capitalists, these investors are often pre-profit. They expect a high rate of return. They typically receive 25 to 50% of their value in exchange for capital. So they're wanting a very high rate of return. And they have a defined exit strategy. So they don't actually make any money until a company is able to pay them through one of three ways. First, they can go public, which is the most preferred way for a venture capital to exit the agreement because that's the way they're going to make the most money. The second is that company is bought out, so it's purchased by another company, so a merger, an acquisition. That would be a way for a venture capitalist to be able to cash in on their investment. And third is for the owner to repurchase that investment made by the venture capitalist, and that's going to be the least reward for their investment. They're going to receive the least amount of money that way. There are, let's see, different types of financing even within this. Some other vocabulary that we need to be aware of. Let's see, grants. This is the direct transfer of funds to private enterprises. So they're not getting ownership in exchange for the money, and they do not have to be repaid. Limited partnerships. Limited partners invest funds in a project and investors receive income and tax benefits. So there must be one liable partner. Mezzanine financing. This is typically used to finance the expansion of existing companies. It is basically debt capital that gives the lender the rights to convert to an ownership or equity interest in the company. Common stock purchase, we've already discussed this. It's ownership of stock that does not promise repayment. Preferred stock payments are also ownership of stock, but it does promise payments. They have an annual fixed dividend. Now, hybrids combine aspects of equity and debt. So convertible debt is a type of debt where the debt holder has the option to convert the debt into equity. So they were able to take that debt that they lent them and convert it to common stock equity. Another type of hybrid is a debt with warrants. This is a loan that's provided to a firm in exchange for the right to purchase some amount of stock at a preset price for a specified period of time. There are different growth stages within a company. We see that the seed and startup phase is where there is limited information, there is high uncertainty. They're building a business, but they're not generating profits or revenue. They're relying on informal sources of capital. Equity is primarily used because there is not enough cash flow to support the debt. A startup phase is slightly different than a seed stage. They have, at this point, they have some assets. They are still very, very small. They have very small growth. And they do have earnings at this point, but they're very unpredictable. The growth stage, that these companies are able to generate sales and they have some profit history. There's more information about the company. The cash flow is more predictable. They now have the ability to utilize debt and have greater access to institutional capital, whether that's debt or equity. And then maturity stage, this is when a company needs to invest to modernize. There are unstable future markets, which make them poorer prospects for debt and equity infusions. They're more likely to depend upon owner financing, informal investors, government programs, economic development finance programs. Now again, that's theory. So these are the theory of our growth stages. Now let's see what happens in reality. We see here that small businesses rely equally on debt and equity. The most popular form of financing, with equity we see that it's owner financing, and with debt we see it's commercial banks. So commercial banks is here. So what we're seeing here is a little bit different than what was predicted by the growth stage. We see that if we look at equity here, we see that equity increases for firms older than 4 years. This is because retained earnings are increasing, which is reducing the reliance on external financing. And we see owners buying out other equity investors and lenders. So you can see buyouts of a company, a publicly traded company, by looking up their tender offers, which is available on the SEC EDGAR's website. It's a file number SC2-I. We see that this is just a snapshot of firms by age. So we're not looking at this by industry. If we were to look at this by industry, we would see some substantial differences. We see that businesses with large startup costs and that have lots of research and development would differ from companies that can generate a profit more quickly. So if they have high research and development, there's going to be higher equity components. Retail would be more likely to generate a profit quickly and would be the most likely to use debt financing. Let's look at a case study. Here we have a company called Green Earth. It's a startup corporation. They have new technology that allows them to combine unsorted plastic waste into molded products. They have agreements to gather waste from various communities and are in the works to supply a major retailer with plastic storage bins made from the recycled plastic. The company is wanting to lease space and set up a manufacturing facility to produce the bins, should they use debt or equity, and what factors may affect their ability to receive financing. This is a startup, first off. Startup, and they need money and cash flow. They need money, but their cash flow is uncertain. They have very few assets to use as collateral. So because of this, they're probably going to have to rely on equity to cover their startup costs. Their ability to raise venture capital would depend upon the market size and the earnings potential of their business. It is in a popular area, which pre-IPO investors like venture capitalists seek out popular things to do because it will result in a larger chance of an IPO with greater earnings. So recycling is popular, so it may be a fad. Investors are often driven to invest in fads. Once Green Earth has secured enough cash to open, they should be able to finance the purchase of equipment with debt. I'm sure that equipment will be expensive and that it will be able to stand for its own collateral. Let's look at a second option, a second case. Grocery World is a successful urban grocery store that has been in operations for 15 years. They currently have a 13,000 square foot store. They have signed an 8-year lease at a slightly smaller secondary location in another neighborhood. The new store will be located on the ground floor of a newly renovated low-income housing development. Grocery World needs to obtain financing in order to make improvements to the space. They need to acquire equipment and inventory and cover other operating expenses until their store generates positive cash flow. What is the firm's capacity to support debt or equity, and what are their likely sources of financing? So, existing Grocery World is a successful urban grocery store. I'm sure they have upper middle income clientele, but they're wanting to expand to a second location in a low income neighborhood. So it's got components of both a startup and an expansion. Yes, they've been a successful grocery store, but never in this market. The second store is in a different type of location and must establish a totally different customer base. So future sales and growth are uncertain, but they do have a successful track record. So I would think they'd have lots of different options here. First, they could get trade credit from their suppliers to acquire inventory. Largest source of short-term financing available. If bank loans aren't possible, they may have to use equity from the first store to make improvements. They could use the cash flow and assets from the first store to get a loan if necessary. Or they could ask the landlord to make the improvements and then be charged higher rent. The landlord would charge them higher rent to cover those costs. So it's an interesting case. Lots of different options here. Now they may be able to find a loan simply because they do have a long history, and the bank may be able to overlook the startup nature if there's few other grocery stores and little competition, but it's an interesting case. That's it for this section.